The USA is drowning in debt. We're talking $35 trillion, or basically an insane amount of money. This is America's national debt, and when you stack it up against our GDP, it's sitting at roughly 125%. According to the number crunchers, this year the US government is going to shell out $892 billion just in interest payments alone. Now get this, for fiscal year 2024, we pulled in $4.08 trillion in revenue, which means 22% of everything America makes is going straight to interest payments. That's wild. And the way we're racking up debt. Experts are saying that in the next decade, the US is going to have to pay $12.9 trillion in interest. So can America actually make these payments? The interest? Maybe. The principal amount? Not a chance. But here's a mind-blowing question for you. If every country on the planet was told today to pay off their entire debt, how many do you think would go bankrupt? 50%? 70%? 80%? Nope. 100%? Yeah, you heard that right. There's not a single country in the world that could pay off its debt completely. Why? Because there's literally not enough money in the world to cover all the debt that exists. Sounds crazy, right? In this video, I'm going to break down our debt-based monetary system, how we got here, how the US is gaming the system, and how it's going to affect the rest of the world. Today, I'm going to share with you the eye-opening truth about how modern money is actually created. Let's roll it back to the beginning. Trade has been a core part of human society for thousands of years. The OG form was the barter system, where people traded goods and services based on what they needed. But the barter system? Total mess. Picture this. If someone makes a tent and needs shoes, they'd have to give up a whole tent just for one pair of shoes. That's not exactly a fair trade. So we needed something better, a medium of exchange. But this wasn't money yet. The first form of money was actually shells. Pretty random, right? Now to buy anything, you didn't have to swap your goods. You just handed over some shells. The only problem? These shells were everywhere. You could literally just grab some from the beach and boom, you've got money. So we tried other stuff. Sometimes cattle, sometimes grain, but none of it worked perfectly. You could breed more cattle or grow more grain to get rich, and that defeated the whole purpose. We needed something that was rare and valuable above everything else. That's when humans started trading with gold, a precious metal that couldn't just be made by people. This is what made gold the ultimate money. Eventually, gold got minted into equal-sized coins, and from that point on, trade absolutely exploded. But as trade grew bigger, people started doing international deals, and gold became a pain to use. If you're making huge transactions, carrying tons of gold across long distances was sketchy and dangerous. So we came up with a solution: receipts, or what we now call paper money. Here's how it worked. If Trader X buys goods from Trader Y worth 1,000 grams of gold, instead of hauling around actual gold, X would give Y a receipt saying 1,000 grams of gold is reserved for you in this specific vault or bank. Y could then withdraw that gold or use the same receipt to buy other stuff without lugging around any gold. But remember, money was still gold. The value wasn't in these papers, it was in the gold backing them up. Over time, we made these receipts better and better. Every country started making its own currency. By 1873, pretty much every country had its own money, and each currency was backed by a specific amount of gold. This meant if I had $20, I could walk into any bank and swap it for $20 worth of actual gold. This system hummed along for about 40 years until 1914 when World War I broke out. Major countries across the globe got dragged into this war, and to win it, every nation started dumping money into military, weapons, and tanks. The spending got so insane that countries literally ran out of money, so they hatched a plan. Up until then, $20 paper money equaled $20 worth of gold. But here's the thing. For most spending, people only needed the paper money. The gold just sat in vaults. So during the war, the USA and other developed countries thought, what if we print more paper money than we actually have in gold? Like printing $50 in paper money against only $20 worth of gold. This way, they could fund their war expenses and hopefully come out on top. So a new monetary system was born, the gold exchange standard. Currencies were now only partially backed by gold. Now $50 in paper money could only be exchanged for $20 worth of actual gold. Then, in 1939, World War II hit. Here's an interesting thing about wars. Whatever country gets involved throws every single resource at winning. They turn their workers into soldiers, toaster factories into gun manufacturers, and car plants into tank factories. That's why they have to import all their basic consumer goods from countries that aren't fighting. Now, the US joined both World War I and World War II pretty late in the game. For most of these wars, America was just exporting basic consumer goods to European countries that were busy fighting. In fact, because the US was trading in gold, By the end of World War II, America had cornered 2/3 of the entire world's gold supply. Meanwhile, the rest of the world had only 1/3 of the gold left, and Europe had barely any. They just had dollars because during World War II, Europe borrowed massive amounts of money from the US, and all those loans were in dollars. Then, once again, a new monetary system was introduced. The system that made the USA a superpower and turned the dollar into the world's reserve currency, the Bretton Woods system. In this system, other countries' currencies weren't directly backed by gold anymore. Instead, they were backed by gold through dollars. So if my currency is the pound, I'd get dollars in exchange for pounds, and then I could exchange those dollars for gold at the rate of $35 per ounce. Over the next 2 decades, the US milked this system for everything it was worth. After World War II, America funded tons of wars. The Korean War, Vietnam War, Cambodian Civil War, you name it. Because world trade was now done in dollars, the US just printed new dollars to pay for these wars and shipped them off to their allies. Gradually, the US had way more paper dollars floating around than they actually had gold to back them up. They figured very few countries would actually show up asking to trade their dollars for gold, so they just kept the printing presses running. But then, one day, this happened. The president of France, Charles de Gaulle, basically called out America on their BS. He told his country that America was scamming the whole world and that the real value was in gold, not their dollars. After this speech, France started pulling gold from the US, and seeing this, other countries jumped on board too. By 1971, the USA had lost 50% of its gold reserves. The US government was freaking out, and before they could lose everything, on August 15, 1971, President Richard Nixon made a huge announcement. Nixon rolled out a new monetary system, the dollar standard. According to this, world trade would still happen in dollars, but dollars would no longer be redeemable for gold. From this point forward, every currency in the world became fiat currency, basically money that has no real intrinsic value and is only worth something because of trust and confidence, which comes from the stamp of the central bank on the paper. This is our current system. But there are some wild details about this system that most people don't get, like the fact that there's not as much currency in the world as there is debt. To understand this, we first need to understand how modern money is created. Since the US kicked off this system, we'll use America as the example. But remember, pretty much every country in the world creates its currency in a similar way. 2 government bodies are involved. First, the government itself, and second, the central bank. Both operate independently. In the US, the body representing the government is called the Treasury Department, and the central bank is the Federal Reserve. Let's say there's no currency or money in the US at all. To kickstart the economy, the government needs money. Let's say $1 trillion. The central bank will provide this, but not for free. It's given as a loan. Basically, whenever the government needs funds, it issues bonds for that exact amount. In this case, the US Treasury issues bonds worth $1 trillion with a promise to pay it back in the future plus interest. These are called government bonds, or in the US, Treasury bonds. These Treasury bonds get sold to the central bank of the USA, and the Federal Reserve prints dollars to pay for these bonds. This is how paper money comes into existence. In economics, this paper money is called base money. As soon as these dollars go to the US government, they start spending them on infrastructure, education, social welfare projects, and slowly these dollars get distributed to people working on these projects. After people make their necessary purchases, they deposit their savings in a bank. This is where the real money creation magic happens. Let's say you deposit $100 in a bank. According to their business model, the bank keeps a certain percentage of this deposit as a reserve and loans out the rest. The bank decides how much to keep based on something called the reserve ratio, which is set by the country's central bank. Reserve ratios vary for different types of loans, but let's say the reserve ratio in the US is 10%. This means out of your $100, the bank keeps $10 and loans out $90. Now the bank has 2 accounts, yours and the borrower's. Your account still shows $100, but the bank only has $10 in actual cash. That $90 in your account is just a number. Meanwhile, the borrower has $90 in cash. The bank has effectively created $190 from your original $100. When the borrower spends that $90, whoever gets that money will probably deposit it back in a bank. The bank again keeps 10% and loans out 90%, which is $81. Now the $190 becomes $271. This keeps going until that initial $100 deposit grows to 10 times its value, $1,000. This is how the banking system expands currency in the economy. As I mentioned, reserve ratios vary, sometimes 10%, sometimes 5%, sometimes even 0%. Now this expansion starts with just $100. But since the US government injected $1 trillion into the economy, which eventually comes back to banks as deposits, imagine how much those $1 trillion can expand, especially if the reserve ratio is 0. This is how a country's currency supply works. It's a combination of base money printed by the central bank and the expansion that banks create by literally just typing numbers. In fact, 92 to 96% of our currency isn't created by the government. It's created by banks. Now here's the most important part: debt. Let's rewind a bit. Remember when I said the US government takes its very first dollar as a loan by issuing a bond, promising to pay it back with interest? Let's say the interest is $1. But here's the kicker. If they only borrowed $1, where does the second dollar to pay the interest come from? Well, they have to borrow that second dollar too, but there's interest due on that one as well. Exactly. Now think about this. There's interest due on the bonds the government issues, and there's also interest due on all the loans that banks give out. This means for every single unit of currency that exists in this world, there's interest owed on it. And this is why I said there will never be enough currency in the world to pay off all the debt. Sure, debt can be reduced, but it can never be completely paid off. Now let's connect this back to 1971. When the dollar standard was announced, all existing dollars lost their gold backing. And in place of that gold, an equivalent amount of government bonds was issued, which became the USA's national debt. The interest on this national debt is now being paid by the US government using tax revenue, the taxes that citizens are paying. This means every time the Fed prints money, it adds to America's national debt, and the interest portion of tax revenue keeps growing. The problem is, tax revenue is the government's main income. They cover regular expenses from this revenue, and if most of it starts going just to pay interest, they won't have enough left for other expenses. If there aren't enough funds to cover these expenses, the government issues more bonds, and the central bank prints more currency. It becomes a never-ending cycle that just keeps feeding itself. Although U.S. Treasury bonds are also bought by foreign countries, the U.S. government gets its major funding from the Federal Reserve through printing dollars. Check out this chart. This is the Federal Reserve's balance sheet. It took the Fed 200 years to print a total of $25 billion. But then in 2008, the global financial crisis hit. To bail out banks and save the economy, the U.S. Fed started printing money like crazy. By the end of 2008, their balance sheet had exploded by a massive $2.5 trillion. Then, there was another huge spike during the 2020 COVID crisis. That year alone, within just 3 months, the US Fed printed $3 trillion, and by 2022, their balance sheet hit $9 trillion. The point is, time and time again, the US Fed just keeps printing. And remember, this is just their base money. Now imagine how much currency expansion is happening through the US banking system on top of that. The problem is that all this printing doesn't just increase America's interest payments, it also waters down the value of the dollar. From 1971 till today, the dollar has lost 98% of its value. This means if a dollar could buy 10 apples in 1971, today that same dollar can only buy 0.2 apples. If any other country in the world printed money at this pace, they would have already crashed into hyperinflation. So far, the USA is surviving only because the dollar is still the world's reserve currency, and their supply gets absorbed by the entire global economy. As of 2022, 88% of all international transactions still happen in dollars. But this doesn't mean the USA and their currency can never collapse. Actually, the whole world is waking up to the fact that America isn't as strong as it used to be. That's why countries like China are now stacking gold instead of investing in US bond markets. Gold represents real, tangible value. Plus, China has started doing 20 to 30% of its trade in yuan. Various country groups like BRICS and ASEAN are increasingly trading in their local currencies. Most importantly, oil, which is probably the most significant import for almost every country, is now being traded in other currencies too. For example, Russia sells oil to its buyers in their local currencies. India even trades oil with Russia using the Indian rupee. Saudi Arabia, the world's biggest oil exporter and America's most important ally, has also started accepting payments for its oil in different currencies. And these are just a few examples. There are tons of other de-dollarizing trade deals that either already exist or are in the works. For over 80 years, the USA has been exploiting its power, but now it's looking like doomsday for America might not be that far off. That's it for today. If you dug this video, don't forget to smash that like button, share it around, and subscribe to the channel. I'll catch you in the next one.